Hello students. In today's video we are going to understand about the topic capital structure. Before we understand the whole topic in detail, let's understand the terms first. What is capital and what is structure? Capital is the funds, is the amount which is coming in the organization by many sources, and structure is its frame. Let's understand it with the help of an example. If you have to calculate an area of a room, how much is it occupying? How will you calculate? By its length, by its breadth, by its height, isn't it? So same way, if it is required to know what is the frame, what is the area of a business, how big it is, how expanded it is important to understand its capital structure. Now when we talk about capital, there are many sources through which the funds come in an organization, and on the basis of ownership, the organization can arrange the funds through equity shares, through preference shares, and through retained earning. And if we talk about the borrower's fund, then banks are there, financial institutions are there, public deposits are there, and commercial papers. There are many other securities through which the funds can come in an organization. So basically, capital structure is a combination, it's a mixture of owner's fund and borrower's fund. Important is when this mixture is getting prepared by the financial manager, what is going to be the proportion? Because each organization has its own way of working, every organization has its own requirement. So the proportion of ratio, the proportion of debt and equity is not need to be same and similar for all the organization. It keeps on changing with the time. In fact, even one organization who started with one ratio may change its proportion with the span of time, with the project, with the necessity of the organization. I hope this simple explanation is easier to understand what capital structure is. Let's understand it more deeply with the help of the statement. It refers to a proportion of debt. Debt is borrowed funds, and equity, which is owner's fund. So as I said, that it is a proportion, it is a combination of borrowed funds and owner's fund. Now you need to understand this term, that every time when we will be talking about owners and borrowers fund, we're not going to call it by these names. Instead we'll be calling it by debt and equity. So if I'm saying debt, that means I'm talking about the borrowed funds. If I'm talking about equity, then I'm talking about the owner's fund. So it's a proportion of borrowed funds and owner's fund. It is a proportion of debt and equity used for financing the operations. Now what is financing? Financing over here means helping the organization financially in completing its activities, in completing the tasks of the business. So if the business is involved in any kind of activity, in the production activity, in the marketing activity, in the sales activity, in hiring the staff, or you think of any activity which is happening in the organization, definitely it requires some funds. And these funds will be coming through the various sources, right? So an organization just cannot completely depend upon one of the sources. So what they do, they create a proportion, they create a capital structure, and this capital structure is a proportion. It is a ratio of debt and equity. So when this debt and equity helps the organization in completing its task, it becomes very smooth for an organization to run its business perfectly and fight in the market. Then we see that over here it says it affects financial. This capital structure is affects the profitability and financial risk. Now let's understand. One thing which I have made you clear in the previous videos is that when the organization is going to raise the funds by any of the source, either by debt or by equity, you need to understand this, that raising the funds through equity is always expensive. Yes students, raising the funds through equity shares को issue करके funds raise करना is always expensive. So what happens, the organization prefers to issue debt. Debt is the borrowed funds. So it issues the security of borrowed funds. Now borrowed funds are definitely cheaper in cost. An organization don't have to spend too much of money, so the cost level decreases. In that case, the profitability can be more in the organization, because organization don't have to spend too much of cost, too much of money in raising the funds through the debt. But at the same time, what increases? Financial risk. Because every time organization has to pay back the amount, any funds which they are getting by borrowed funds, by debt, they have to return that amount with some dividend, with some interest, right? And in case if the organization is not earning enough profit, then how it will give its it will give the refunds to the investors from whom it has borrowed the funds. So that's why there is a financial risk. Definitely there is a profitability, that the cost increases because the company is preferring to issue the debt securities. Through that, the organization is going to raise the funds, that brings the profitability, but there is a financial risks as well. Now, how do we compute, how do we calculate the capital structure? It is a combination of debt by equity. So debt is divided by equity when we do any kind of numerical calculations. Now, you need to understand there are two terminologies which usually comes under capital structure. One is financial leverage, another one is trade on equity. When we talk about the term financial leverage, before we understand this technical term, let's understand a simple meaning of leverage. It is a leverage is something used to take advantage of. Leverage means something used to take advantage of, किसी चीज का फायदा उठाना. So over here, financial leverage means when these funds which are coming, जब उसका हम फायदा उठा सकते हैं, that means when the organization is borrowing these funds and is using these funds in an appropriate manner, in a proper manner, then it is called as financial leverage. Now it can be further explained with the help of the 3 points. It refers to a financial ratio. Again, when we are talking about that the funds are coming and the organization is going to use those funds, definitely it will be giving more advantage, more benefits to the organization. So how the organization will take the advantage? By preparing a financial ratio, right? Financial ratio, which is going to be the combination of debt and equity. So it refers to a financial ratio which, now what this financial ratio is going to reflect, indicate the proportion of debt in the total capital of the enterprise. That means proportion of debt, that if the organization's total capital, let's take an example, if it is 10 lakh rupees, then how much amount has been obtained from debt and how much has been obtained from equity. If debt is 8 lakh and equity is 2 lakh, so that can be the proportion in one company, that is 8:2, right? In some organization it can be 5:5. 5 lakh rupees and 5 lakh rupees. So as I said, it completely depends upon the preference of the organization, that which fund is getting more preference, more proportion. Sometimes it can be debt and sometimes it can be equity, but each one has its own drawbacks and benefits when the organization is giving preference either to debt or to the equity. So here financial leverage can be calculated by knowing that exact how much debt has the organization actually beared out of the total capital of an enterprise. Fine. Number 2 is indicating as financial leverage in a business increases. So when the financial leverage increases, now how financial leverage is increasing? Because the organization is increasing the debt. Remember, the organization is increasing the debt. So as financial leverage in a business increases, the cost of raising funds decreases. The cost of raising fund decreases. I am revising it once again. As I have told you, the organization has got two options through which it can raise the funds, and usually organizations prefer to raise the funds through debt because debt is cheaper than equity. Issuing equity is really expensive. Reason behind, I have already explained that in the previous video, that if the organization is paying some interest or dividend on debt, they don't have to pay tax on that because they have already paid one amount of the profit to the shareholders. So they don't have to pay the tax again from that profit to the government, right? That's why debts are cheaper as compared to equity. So therefore the company always prefers to issue debt. That's why when debt is increasing, that is the financial leverage is increasing, the cost, the expenses of issuing the debt decreases. Fine, I hope you can see that term. The cost of raising the funds decreases because of increased use of cheaper debt. So why is it decreasing? The reason is also given, which I have right now explained you, is because increased use of cheaper debts. Because as I have told you, debts are cheaper, equity are very expensive at the time of issuing it. So every organization always gives the priority to the debts at the time of issuing the shares, issuing the securities. But again, at the same time, the risk increases. It's the same risk which I have explained over here. Is that it is not necessary that the organization is going to get the profit every time. And since the organization has to pay back the debt amount to the security holders from whom they have taken it, so in that case, organizations' retained earning can also be given as a dividend, as an interest in paying back to these debtors, those who have given their savings as a debt to the organization. So that's why there is a financial risk too involved in this financial leverage, in this capital structure. Now, how it can be calculated, how we can see that the financial leverage is favorable, how we can understand that the organization is in a good condition. In fact, after taking a lot of debt, after borrowing so much of money from the debt, still it is in a favorable condition, better condition by a proportion which says return on investment. Return on investment means profit. Any investment which has been done by the organization, the organization is getting the return on it. So what is return? Return is the profit. So when the organization is getting that profit, that is ROI, is greater than, I hope you can see that sign, is greater than rate of interest. Now this is the rate of interest which they have to pay to the shareholders. So the profit is so much, the profit is more than the amount which they have to pay to the security holders. If this is happening, definitely it is a favorable condition because the organization is earning more profit and it is in such a financially sound condition where it can easily pay the interest because the profit level is more than the interest level. And this situation is described as a financial leverage and it is favorable. And unfavorable condition is just vice versa, that when the organization has taken too much of debt but the profit level is not increasing, and in that case the organization has to still pay back to the debtors, to the security holders, and that payment is taking place from the retained earning or from the owner's fund. So that is an unfavorable condition. This is also considered as a financial leverage and it is also called as a trade on equity. Remember, it is also called as financial leverage, whereas these activities are also called as trade on equity. The statement further says the impact of financial leverage on the profitability. So how impactful this financial leverage is, how profit is it bringing to the organization, we can calculate that with the help of EBIT minus EPS. Now what is EBIT minus EPS is earning before interest and tax. The organization has not paid single penny from the profit which it has earned. So it is a earning before interest and tax. The interest has to be paid to the shareholder, the tax has to be paid to the government, then only the amount which is left will be distributed among the equity shareholders, among the borrowers funds, right? It can be kept as a retained earnings. That's the job of the organization, what it does with its remaining funds, with its savings. So here it is an earning which is before, remember, which is before interest and tax. And what is getting subtracted? Earning per share. How much an organization is earning per share? What is the value of the per share? That is subtracted from this EBIT. This is how trade on equity can be calculated. In our next video, we are going to see an illustration which will be calculating the trade on equity, which will be calculating and telling how organization is earning per share. It will be showing the certain situations, we'll be comparing the situations, we'll be calculating, and we'll be finding how the calculation part takes place. Thank you. See you in the next video.